Imagine this, you finally retired and your Social Security payments start rolling in. It's a moment you've worked for your entire life. But then, tax season arrives and you get a nasty surprise. A big chunk of your benefits are taxable. For many retirees, this unexpected tax bill can turn a comfortable retirement into a stressful one, shrinking their income right when they need it most. But it doesn't have to be this way. Today, we're demystifying Social Security taxes. We'll break down how your benefits are taxed, what triggers the tax, and share smart legal strategies that can help you minimize your tax burden and keep more of your hard-earned money. So let's start with a big surprise for many retirees. Your Social Security benefits might not be tax-free. Whether you pay taxes on your benefits depends on what's called your combined income. This is a mix of your adjusted gross income, any non-taxable interest, and half of your Social Security benefits. Now, if your combined income goes over certain IRS thresholds, a chunk of your benefits, up to 85%, can be taxed. That sounds like double taxation. So what does that actually mean? It's not as bad as it sounds. It doesn't mean 85% of your benefits disappear in taxes. It just means that up to 85% of your benefits could be added to your taxable income for the year. You'd then pay taxes on that amount at your usual income tax rate. While that's an important distinction, those taxes can still take a bite out of your retirement budget. So forgetting about them can lead to a nasty surprise when you realize you have less spending money than you've planned for. This is exactly why you can't think about Social Security in a vacuum. To build a solid financial future, your Social Security plan needs to work hand in hand with the rest of your retirement strategy, like withdrawals from your 401k or your IRA, because receiving your first tax bill on Social Security benefits can become an unwelcome surprise for many retirees, often disrupting their carefully planned cash flow. To avoid this shock, it's best to understand the tax rules before you start claiming benefits. This way, you can ensure your retirement income plan works exactly as you've envisioned it. Now, let's talk about the key calculation behind all of this. The IRS uses something called provisional income to determine how much of your Social Security benefit may be taxable. Now, provisional income includes three things: your adjusted gross income, any non-taxable interest, such as interest from municipal bonds, and half of your Social Security benefits. Once those numbers are added together, the IRS compares the total to specific thresholds. For single filers, if your provisional income is below $25,000, your Social Security benefits generally are not taxable. If it falls between $25,000 and $34,000, up to 50% of your benefits may be taxable. And now if it rises above $34,000, then up to 85% of your benefits may be taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000. Below $32,000, benefits generally are not taxable. Between $32,000 and $44,000, up to 50% may be taxable. And above $44,000, up to 84% may be taxable. And one important thing to understand is this: these thresholds do not adjust based on when you claim Social Security. Claiming at 62, full retirement age, or 70 does not change the actual thresholds themselves. Your claiming age affects your benefit amount, but your total income determines the tax treatment. But here is where many retirees get caught off guard. Social Security alone may not push them into a taxable range. It's often their retirement income that does it. So what other income sources can trigger taxes on your Social Security? One of the big ones is RMDs, or required minimum distributions. When you turn 73, the IRS usually makes you start taking money out of your traditional IRAs and your 401ks. This money counts as income, which can bump up your provisional income and make more of your Social Security benefits taxable. Now, investment income can do the same. Interests, dividends, and capital gains all add to your taxable income, even if you think you're invested conservatively. Income from different sources can push you over the Social Security tax thresholds. And pensions, you guessed it, they could also play a role. This is why focusing on getting the biggest Social Security check isn't the whole story. It's not just about how much you get, it's about how much you get to keep and spend after taxes so you could have more life with less limits. Now, retirement tax planning can feel like a puzzle. It's not just about Social Security, it's about how all your income sources fit together. Combining your Social Security with IRA withdrawals, pensions, and investment income can create a tricky tax situation. That's why effective retirement tax planning is all about coordination, not just looking at one income source at a time. Now let's talk about one of the most useful tools for managing Social Security taxes in retirement: Roth accounts. Generally, qualified withdrawals from a Roth IRA or Roth 401k don't count towards your provisional income. This makes Roth money incredibly valuable when you're trying to manage how much your Social Security is taxed. This is why Roth conversions can be such a powerful strategy, especially before you retire or during lower income years early in retirement. And by converting some of your traditional IRA money to a Roth before you start collecting Social Security or before RMDs kick in, you could lower your future taxable income and have more flexibility down the road. Having that kind of tax diversification gives you more control over how you fund your retirement from year to year. Now, while federal taxes often steal the spotlight, it's crucial not to overlook the impact of state taxes, especially for retirees. State tax policies can significantly influence your financial well-being during your golden years. So maybe you want to move to a state with no state income tax, but you definitely need to account for it. Now, the good news is, for many, is that a majority of states don't have this income tax on Social Security benefits, which allows retirees to keep more of their hard-earned money. But you need to be aware what the state rules are for each and every situation you might be in. The challenge, however, is that a handful of states do still tax these benefits. To make matters more complex, each of these states has their own set of rules, exemptions, and income rules when thresholds are applied. This means two retirees with identical Social Security income could have different tax bills simply based on where they choose to live. This variation means where you live in retirement can affect your after-tax income. And for some retirees, a relocation decision isn't just about better climate or lower cost of living. It's also a strategic move based on tax efficiencies. Now, this doesn't mean everyone should just pack up and move. Of course, many factors such as family, community, and healthcare access play a role in the decision. But it doesn't mean that your choice of location should be an integral part of a larger retirement plan conversation with your financial advisor. Now, when you think your Social Security check and it comes to mind, what numbers are you thinking of? For most retirees, it's the total amount they'll receive. But what about the amount you'll keep after taxes? Overlooking the impact of federal and state taxes on your benefit could cost you thousands of dollars throughout your retirement. So what does this all mean for retirees? Let's break it down to some practical steps. One idea is to tap into your traditional retirement accounts early on, before Social Security kicks in or those required minimum distributions start. This can shrink your future required withdrawals and help you avoid getting bumped into a higher tax bracket down the road. Another move to consider is converting to a Roth IRA, especially in years when your tax bracket is on the lower side. If your timing is right, you could set yourself up with tax-free income flexibility later in life. Now, a third strategy is all about coordinating where you pull income from. Instead of just drawing from the same account year after year, it could be smarter to strategically pull from your taxable, tax-deferred, and tax-free accounts based on what the market is doing and where tax thresholds are. This is where retirement planning goes beyond just filing your taxes. It becomes what we call income engineering. At Retirement Capital, this is exactly why we look at the big picture. We integrate your Social Security plan with your income, investments, your tax strategy, your health care concerns, and your overall legacy goals. And when all these pieces work together, retirement is not only more efficient, but also a lot less stressful. So here's the bottom line. While Social Security is a crucial retirement income source, it isn't automatically tax-free. The amount of your benefit that gets taxed hinges on several factors, including, like we've discussed, your provisional income, your filing status, other income sources, and even your state of residence. Now, the good news is, with smart planning, you can manage these tax implications by understanding the rules before you retire. Instead of being blindsided by a surprise tax bill, you could take control and shape a more secure financial future. Now, if this video helped you better understand Social Security and taxes and how they overall work together, make sure you subscribe right now for more retirement education, entertainment, and sometimes just a little humor along the way, because we want to help you build clarity and confidence in retirement. And if you need any help building a tax-smart retirement income strategy, book a connection conversation today in our offices in Florida or on Zoom. We're happy to meet you where you are so we can help take the retirement you've imagined and turn it into an actual reality, because we want you to have more life and less limits when it comes to your retirement.